The prospect of keeping more of your hard-earned money is undeniably appealing. This allure is precisely why states with no income tax often top the list for individuals and families seeking financial relief. The idea is simple. Eliminate the state income tax and watch as residents enjoy greater financial freedom. However, this seemingly straightforward equation often obscures a more complex reality. While the absence of a state income tax is undoubtedly a significant financial factor, it's crucial to recognize that it is rarely, if ever, the sole determinant of overall affordability. The truth is that states, like individuals, must generate revenue to fund essential services such as education, infrastructure, and healthcare. When one revenue stream like income tax is absent, states must compensate by relying more heavily on other sources. This often translates into higher property taxes, sales taxes, and various fees, which can quickly erode the perceived financial gains of living in a no-income tax state. In essence, the absence of a state income tax doesn't necessarily equate to a financial utopia. Rather, it represents a trade-off, a rebalancing of the scales where different taxes and fees come into play. To truly assess the affordability of a state, it's essential to look beyond the allure of zero income tax and delve into the often hidden costs that can significantly impact your bottom line. One of the most significant hidden costs in no-income tax states is often the property tax burden. While the absence of state income tax might seem like a financial relief, the reality is that property taxes can quickly eat into those perceived savings. While property taxes are a fact of life for most homeowners nationwide, their impact is particularly pronounced in states that forego income tax revenue. These states often have to find alternative ways to fund public services, and property taxes become a primary source of revenue. These states often rely heavily on property taxes to bridge the funding gap, resulting in significantly higher rates compared to their income tax levying counterparts. This reliance can lead to a substantial financial burden for homeowners, who might find themselves paying more in property taxes than they would have in state income tax. For homeowners, this can translate into a substantial annual expense, often offsetting any perceived savings from the lack of state income tax. The financial strain can be particularly challenging for those on fixed incomes or for first-time homebuyers trying to enter the market. Take, for instance, the contrast between Texas, a state with no income tax, and California, known for its progressive income tax structure. While Californians might face a hefty income tax bill, Texans often contend with significantly higher property taxes, which can make a significant difference in overall housing costs. While Californians might face a hefty income tax bill, Texans often contend with significantly higher property taxes. This difference in tax structure can influence where people choose to live and how they budget for their housing expenses. According to the Tax Foundation, Texas has one of the highest effective property tax rates in the nation, averaging 1.83% in 2023. This high rate can add thousands of dollars to a homeowner's annual expenses, making it a critical factor to consider when evaluating the true cost of living in the state. In contrast, California's average effective property tax rate was a comparatively lower 0.73% during the same period. This lower rate can make a significant difference in the overall affordability of housing, even when accounting for the state's higher income tax rates. This disparity in property tax rates can translate into thousands of dollars in annual expenses for homeowners, effectively negating any perceived savings from the absence of income tax. Homeowners must carefully consider these costs when deciding where to live and how to manage their finances. The impact of high property taxes extends beyond individual homeowners. Elevated property taxes can ripple through the housing market, driving up home prices and making affordability a significant challenge, particularly for first-time homebuyers and those on fixed incomes. Elevated property taxes can ripple through the housing market, driving up home prices and making affordability a significant challenge, particularly for first-time homebuyers and those on fixed incomes. The increased financial burden can make it difficult for these groups to achieve homeownership, further exacerbating issues of housing inequality. In essence, the lack of state income tax doesn't necessarily translate into a more affordable housing market. Instead, it often shifts the burden to property owners in the form of substantial property tax obligations. This shift can have wide-reaching implications for the housing market, influencing everything from home prices to the overall cost of living in these states. As such, it's crucial for potential homeowners to consider all aspects of taxation when making decisions about where to live. While property taxes often take center stage in discussions about hidden costs in no-income tax states, it's crucial not to overlook the impact of sales taxes on everyday expenses. These taxes, though seemingly minor at each transaction, can accumulate over time, creating a significant financial burden. Sales taxes, levied on the purchase of goods and services, might seem like small, incremental costs at the point of sale. However, when you consider the frequency of these purchases, the cumulative effect becomes more apparent. However, they can quickly add up, significantly impacting your overall spending. Imagine buying groceries, clothes, and other essentials regularly. The sales tax on each of these items can lead to a noticeable dent in your budget over time. This is particularly true in no-income tax states that often rely on higher sales tax rates to compensate for lost revenue. These states need to find alternative ways to fund public services and infrastructure, and sales taxes become a primary source of income. Consider Tennessee, another state that prides itself on having no income tax. While this might seem like a financial advantage, the reality is more complex. To offset this revenue shortfall, Tennessee imposes one of the highest average combined state and local sales tax rates in the nation, reaching a hefty 9.55% as of 2023. According to the Tax Foundation. This high rate is necessary to maintain the state's budget and fund essential services. This means that for every $100 spent on taxable goods and services, Tennessee residents shell out an additional $9.55 in sales tax. Over a year, this can amount to hundreds or even thousands of dollars depending on one's spending habits. This might seem like a small price to pay for some, but it can quickly erode the purchasing power of individuals and families, particularly those living on tight budgets. For families already struggling to make ends meet, every dollar counts. Moreover, the impact of sales taxes is often felt most acutely by low-income households, who typically spend a larger proportion of their income on essential goods and services, subject to sales tax. This means that a higher percentage of their limited income goes towards taxes, leaving even less for other necessities. In essence, higher sales taxes can exacerbate income inequality, placing a disproportionate burden on those least able to afford it. This creates a cycle where the poor get poorer, struggling to keep up with the rising costs of living. While states might tout the absence of income tax as a boon for residents, the reality is that higher sales taxes can significantly impact everyday affordability, particularly for essential goods and services. It's important to consider the full picture when evaluating the financial landscape of no-income tax states. Understanding the broader implications of sales taxes can help residents make more informed decisions about their spending and budgeting. It also highlights the need for ongoing discussions about fair and equitable tax policies that consider the needs of all citizens. By being aware of these hidden costs, individuals can better navigate their financial lives, ensuring they are prepared for the true cost of living in no-income tax states. Awareness and education are key to managing the unseen impact on everyday spending. Excise taxes, often levied on specific goods and services like gasoline, cigarettes, and alcohol, represent another avenue for no-income tax states to generate revenue. These taxes are typically added at the point of sale, making them somewhat invisible to the average consumer, yet they play a crucial role in the state's financial ecosystem. While excise taxes are often justified as a means to discourage the consumption of potentially harmful products, they also serve as a reliable revenue stream for states. This dual purpose makes them a favored tool for policymakers who aim to balance public health objectives with fiscal needs. In states without income tax, these excise taxes can be particularly high, effectively offsetting any perceived savings from the lack of income tax, particularly for those who regularly consume these taxed goods. For instance, a family that drives frequently or has a long commute may find that the money they save on income tax is quickly spent at the gas pump. For instance, consider Nevada, a state renowned for its absence of both income tax and sales tax. This makes it an attractive destination for many, but the financial landscape is more complex than it appears at first glance. To compensate for these revenue streams, Nevada imposes relatively high excise taxes, particularly on gasoline. This strategy helps the state maintain its infrastructure and public services without relying on income tax. According to the American Petroleum Institute, Nevada had the 9th highest gasoline excise tax in the nation as of January 2023, at 51.6 cents per gallon. This places a significant burden on drivers, especially those who commute long distances. This high excise tax translates into a significant expense for drivers, especially those who rely heavily on their vehicles for work or daily commutes. Over time, these costs can add up, making a noticeable dent in household budgets. The impact of high excise taxes on gasoline extends beyond individual drivers. Businesses that rely on transportation for their operations also feel the pinch, which can lead to higher prices for goods and services. Elevated gas prices can contribute to inflation, impacting the cost of goods and services across the board. When transportation costs rise, so do the costs of delivering products to stores, which in turn affects retail prices. Moreover, high excise taxes can disproportionately impact rural communities and those with limited access to public transportation, who often rely more heavily on personal vehicles for transportation. In these areas, the lack of alternatives makes the high cost of gasoline even more burdensome. In essence, while excise taxes might seem like a distant concern for some, they can significantly impact the cost of living in no-income tax states, particularly for those who rely on gasoline-powered vehicles. The ripple effects of these taxes are felt in various aspects of daily life, from commuting costs to the price of groceries, making them an integral part of the economic landscape. It's also important to note that the revenue generated from excise taxes is often used to fund essential state services and infrastructure projects. This means that while consumers may feel the pinch at the pump, they are also contributing to the maintenance and development of their communities. In urban areas, the availability of public transportation can mitigate some of the financial strain caused by high gasoline excise taxes. However, the overall tax burden in states without income tax can still be significant when considering all forms of taxation combined. Policymakers continuously debate the best strategies to balance state budgets while minimizing the financial impact on residents. Excise taxes remain a key component of these discussions, highlighting their importance in the broader fiscal landscape.